HoC will now proceed to read the orders of the day.
Bank Resolution Recapitalisation Bill Lords. Second reading.
Now.
Minister to move second reading. Minister.
Madam Deputy Speaker, I beg to move that the bill now be read a second time. Madam Deputy Speaker, the Bank Resolution Recapitalisation Bill will enhance the UK's resolution regime by giving the Bank of England a more flexible toolkit to respond to bank failures. The bill creates a recapitalisation mechanism which will ensure that certain costs of managing the failure of banking institutions do not fall to the taxpayer. It strengthens protections for public funds and financial stability while supporting the competitiveness and growth of the UK financial sector by avoiding placing new upfront costs on the banking sector. It is therefore an important bill that underpins this government's commitment to promote growth and economic stability. The policy in the bill builds on the proposals set out in consultation by the previous government, and I would like to thank the previous government, don't always do that by the way, for the work they did with the Bank of England on the consultation and indeed on the resolution of Silicon Valley Bank back in March 2023. The bill provides the Bank of England with greater flexibility to manage the failure of small banks and thereby embeds lessons learned from the volatility in the UK banking sector in 2023, notably those arising from the failure of SVB UK. I hope, given these origins, that these proposals will be welcomed by honourable members from across the House. Madam Deputy Speaker, the resolution regime was created by the Banking Act 2009 in the wake of the global financial crisis. It provides the Bank of England with a set of tools to manage the failure of financial institutions in a way that limits risk to financial stability, public funds and indeed the UK economy. The regime was introduced in recognition of the global consensus that reforms were needed to end too big to fail and to ensure that where necessary financial institutions can be supported to fail in an orderly fashion. This regime has been developed and steadily added to by successive governments over the past decade. That work has given the UK a robust regime that reflects relevant international standards and supports the UK's role and reputation as a leader in financial regulation, enhancing confidence in our financial system and making the UK a more secure and attractive place to invest. The resolution regime was last used to resolve Silicon Valley Bank UK, the UK subsidiary of the US firm that collapsed in March 2023. The Bank of England used its transfer powers under the Banking Act to effect the sale of Silicon Valley Bank UK to HSBC. That delivered good outcomes for financial stability, customers and taxpayers, Madam Deputy Speaker. All of the bank's customers were able to continue accessing their bank accounts and other facilities, and all deposits remained safe, secure and accessible. The Bank of England achieved the continuity of banking services and maintained public confidence in the stability of the UK financial system. The case of Silicon Valley Bank UK demonstrated the effectiveness and robustness of the resolution regime. However, as would be appropriate following any bank failure, the Treasury, the Bank of England and their international counterparts reflected carefully following this period of banking sector volatility. And following that reflection, the government concluded that there is a case for a targeted enhancement to give the Bank of England greater flexibility to manage the failure of smaller banks like Silicon Valley Bank UK. At this point, I should explain that the Bank of England generally expects to place failing small banks into insolvency under the bank insolvency procedure. This is because their failures are not generally expected to meet the conditions that must be satisfied for the Bank of England to exercise its resolution powers. One of these conditions is that winding up the bank would not achieve the resolution objectives to the same extent as would be achieved by using the resolution powers. These objectives include protecting UK financial stability, covered depositors and public funds. When a failing firm enters insolvency, its eligible depositors are paid up to £85,000 each within 7 days by the Financial Services Compensation Scheme, with higher limits for temporary high balances. This compensation is funded initially through a levy on the banking sector and then, to the extent possible, recovered from the estate of the failed firm. As was seen in Silicon Valley Bank, it is the government's view that in some cases of small bank failure, the public interest and resolution objectives are better served by the use of resolution powers than by placing the firm into insolvency. Smaller banks are not required to hold additional funds and liabilities that could be bailed in during a resolution. This means that in a case in which a small bank does need to be resolved, additional capital may be required to support a successful resolution. For example, funds may be required for the bank in resolution to meet the minimum capital requirements for authorisation or to sustain market confidence. At present, these recapitalisation costs, Madam Deputy Speaker, have to be borne by public funds. And the government believes that this is a situation that should be avoided to protect taxpayers from bearing these costs. And I hope the opposition agree. We'll see in a minute. To that end, the Banking Resolution Recapitalisation Bill aims to strengthen the protections for public funds when a small bank is placed into resolution. Overall, this is a prudent set of reforms to ensure the resolution regime continues to effectively limit risks to financial stability and indeed to taxpayers. The bill does not make widespread changes to a regime that is working well, and so it's important to emphasise that the bank insolvency procedure will continue to play an important role in managing the failure of small banks. That said, this bill reflects the government's belief that a targeted set of changes is needed to ensure that, if necessary, existing resolution powers can be applied to small banks to achieve good outcomes for financial stability while also protecting taxpayers. Madam Deputy Speaker, this bill achieves this by introducing a new recapitalisation mechanism. This mechanism allows the Bank of England to use funds provided by the banking sector to cover certain costs associated with resolving a failing banking institution. And the bill does four main things. Firstly, it expands the statutory functions of the Financial Services Compensation Scheme. The bill gives the Bank of England the power to require the Financial Services Compensation Scheme to provide it with funds to be used to support the resolution of a failing bank. Secondly, it allows the Financial Services Compensation Scheme to recover the funds provided to the Bank of England by charging levies on the banking sector. This mirrors the arrangement for funding payouts to covered depositors in insolvency, with the exception of the treatment of credit unions, to which I will return shortly. Thirdly, the bill gives the Bank of England an express ability to require a bank in resolution to issue new shares, facilitating the use of industry funds to meet a failing bank's recapitalisation costs. Finally, following constructive debate in the other place, the bill also sets a number of accountability measures that apply when the Bank of England uses the recapitalisation mechanism. The bill consists of 8 clauses to deliver these key components. I will go through them briefly. The first clause inserts a new section into the Financial Services and Markets Act 2000, which introduces the new mechanism. It allows the Bank of England to require the Financial Services Compensation Scheme to provide the Bank of England with funds when using its resolution powers to transfer a failing firm to a private sector purchaser or bridge bank. It sets out that these funds can be used for, namely to cover the costs of recapitalising the firm and the expenses of the Bank of England or relevant persons in taking the resolution action. Relevant persons for this purpose means the Treasury or a bridge bank or asset management vehicle operated by the Bank of England. It allows the Financial Services Compensation Scheme to recover the funds provided through levies. The second clause sets out the reporting requirements for the Bank of England when it uses the recapitalisation mechanism, added to the bill by the government in the other place. The Bank of England must report to the Chancellor on the use of the recapitalisation mechanism and stabilisation option it was used in connection with. The Treasury can specify the content and timing of these reports, though if a final report is not produced within 3 months, the Bank of England must produce an interim report within that 3-month period. The Chancellor must lay all reports before Parliament, though the clause allows discretion to omit any information that it would not be in the public interest to publish. The third clause, also added by the government in the other place, requires the Bank of England to notify the chairs of the relevant parliamentary committees in this House and the other place, namely in the House of Commons, the Treasury Select Committee, and indeed in the House of Lords, the Financial Services Regulation Committee, as soon as reasonably practicable after using the mechanism. The fourth clause sets out that the Bank of England must reimburse the Financial Services Compensation Scheme for any funds it provides that were not needed. The fifth clause, added by the government in the other place, sets out that the Treasury must include guidance on the contents of reports on use of the mechanism in the Code of Practice, a statutory document that the Treasury must publish and that the Bank of England must have regard to, which explains how the resolution regime is intended to work in practice. The 6th and 7th clauses make several consequential amendments to reflect the introduction of the new mechanism. The 6th clause primarily ensures that existing provisions relating to the Financial Services Compensation Scheme apply to the new mechanism in the same way. The most substantive provision specifies that the Financial Services Compensation Scheme cannot levy credit unions to recoup funds provided under this mechanism, added to the bill before its introduction to Parliament in response to valid concerns raised by industry. Regarding the 7th clause, which contains mostly technical consequential amendments, the most substantive change gives the Bank of England the power to require a failing firm to issue new shares. This will make it easier for the Bank of England to use the funds provided by the Financial Services Compensation Scheme to recapitalise the firm by using the funds to buy the new shares. The 8th and final clause sets out procedural matters, including that the Treasury may make regulations to commence the provisions in the bill. Madam Deputy Speaker, I'm grateful to the Financial Secretary to the Treasury in the other place for shepherding this bill's successful passage. And as I've already alluded to, the Government made a number of amendments to the bill in the other place following very constructive debate, feedback and engagement. These include the insertion of the requirements of the Bank of England to report to the Treasury and notify parliamentary committees, as I've already outlined. The Government also amended the bill to ensure that there is clarity over whose expenses could be covered by funds provided through the mechanism. In addition, the Government published a number of important documents during the early stages of the bill's passage, including a draft update to the Government's Code of Practice setting out how it expects the mechanism to be used in practice. However, there remains one area of the bill that will require the attention of this House, which is the question of the scope of the mechanism. Madam Deputy Speaker, by which I mean which firms the Bank of England can use the mechanism on to support their failure. This was heavily debated in the other place and reflects a concern about the risk of the mechanism being used on a wide range of firms with potential for large levies as a consequence. These concerns led to an amendment to the bill that intended to exclude from the scope of the mechanism those banks that already hold the full set of equity and debt resources, so-called MREL, necessary to manage their own failure. The intent in doing so was to limit the scope to only those banks not required to hold additional capital resources or those banks who have not yet raised the full amount of additional resources to fully support their own failure. As I've alluded to, the Government does note and appreciate the concerns being raised on this point. But as the Financial Secretary to the Treasury made clear during the bill's passage in the other place, the Government is clear that this bill is primarily intended for smaller banks. And my predecessor made a written statement to the House on the 15th of October reiterating this policy position. However, after careful reflection, the Government continues to believe that there should remain some flexibility on this point in the legislation in order to avoid constraining the Bank of England's ability to act and use the mechanism in a highly uncertain crisis scenario. To narrow the scope would constrain the Bank of England's optionality, particularly where it might be necessary to supplement the bail-in of a firm's own resources with additional capital resources. I note this is considered an unlikely outcome rather than a central case, Madam Deputy Speaker. Nevertheless, the Government considers it important to avoid constraining that optionality, given the alternative may be to use public funds. So ultimately, we want to protect the taxpayer. The Government will therefore be tabling an amendment at committee stage to remove the constraint on the scope of application of the new mechanism. Madam Deputy Speaker, more broadly, I want to express my gratitude to the banking sector with whom the Government has engaged with proactively and constructively, both before the bill was introduced and since its introduction. The Government appreciates the feedback it has received from industry and has reflected on it carefully to ensure the bill delivers a proportionate reform. I would particularly note that, as alluded to earlier and in response to feedback from industry, the Government carved out credit unions from levy contributions to recoup funds provided by the Financial Services Compensation Scheme under the recapitalisation mechanism. This was deemed appropriate as credit unions are out of scope of the resolution powers, and therefore it would be disproportionate to require them to contribute towards cost under this mechanism. The Government has also looked to provide reassurances to industry on the impact of this bill. For example, by modelling the mechanism on the existing funding framework for depositor payouts, industry will only be liable to pay levies after the point of failure, avoiding new upfront costs to firms. The government also published a cost-benefit analysis alongside the bill, setting out its general expectation that lifetime costs for levy payers would generally be lower under the mechanism outlined in the bill compared to insolvency. I would also note again the draft updates to the Code of Practice, which the government has published to provide additional transparency to industry and Parliament over how the mechanism is expected to be used in practice.
Will the Minister give way?
I will give way.
Thank you, Madam Speaker. I'm very grateful to the Minister for giving way, and I'm enjoying listening to her speech, and I'm learning quite a lot. I wonder whether she would do me the favour and the House too of giving me her thoughts on how best I could describe the benefits of this bill to the people of Newcastle and Lyme when I go home tonight, because I feel sure she will know far better than me.
Minister.
Well, he flatters me. Thank you. I would like to thank my honourable friend for his question. It isn't that easy to explain, but I'll do my best in simple terms. Essentially, if a small bank is in trouble and it is better for that bank not to go into insolvency, and it is better for it to go through resolution to protect its depositors, which in the case of SVB, only 14% of deposits were covered by the Financial Services Compensation Scheme, because the scheme only covers deposits up until that £85,000 threshold. If public funds had been required to facilitate the sale of SVB to another purchaser, in this case HSBC, but it could have been another institution, then that would have had recourse to public funds. And what we are seeking to avoid is that the taxpayers in his constituency and all of our constituencies are not on the hook for small bank failures. And indeed to facilitate, when a bank has got high quality assets, which was the case of SVB, and therefore we could avoid the insolvency situation and pay out to depositors who had deposits above that £85,000 threshold, that the Financial Services Compensation Scheme and ultimately the banks that contribute through a levy to the Financial Services Compensation Scheme would fund that resolution. I hope that helps. I'm sorry it was a bit long. Mr. Speaker, stability is at the heart of the government's agenda for economic growth, because when we do not have economic and financial stability, it is working people who pay the price. And I thank again my honourable friend for the question, because we do have to bear in mind what we're seeking to do here, which is ultimately to protect the interests of the taxpayer and to ensure that we do not have to have recourse to public funds.
On that point?
Yes, of course.
Thank you, Madam Deputy Speaker. I'm grateful to the Minister for giving way. Can she give, I welcome the bill that the Minister is bringing forward, but can she give an assurance to the House that at all times the aim of the government is to minimise the liability of the taxpayer, and where losses have to be sustained, it should first of all be borne by the shareholders, and secondly by the bondholders, and then thirdly and regretfully perhaps by deposit holders, but that should be the order in which losses are sustained.
Indeed, I do agree, and he put it very well. He will know that in the case of Credit Suisse there was a different order, but we said that the government at the time said that that wouldn't be their order of priority. But indeed, we are seeking to protect the taxpayer in this bill, and he is right that if there had been a cost of the transfer of SVB, it would have fallen to those people first, before falling to the taxpayer. But in this instance, if we pass this legislation, which I hope there's cross-party support for, that will avoid that eventuality, because if we, in the order of priority as he set out, if we get to the Financial Services Compensation Scheme, it will be a levy on the banks in that scheme. I thank him for his question. The resolution regime is a critical source of stability when banks fail by ensuring public funds and taxpayer money is protected. This bill delivers a proportionate and targeted enhancement to the resolution regime to ensure it continues to provide that important stability. It is therefore, as I said at the start of this debate, an important bill that underpins the government's vision for economic growth, and I commend it to the House, Madam Deputy Speaker.
I call the Shadow Minister, Mark Garnier.
Well, thank you very much, Madam Deputy Speaker. And first of all, can I welcome the new Minister to her place? I think this is her first bill that she's taken through as Economic Secretary. And interestingly, she is absolutely right. This is one of those many frequent occasions that we're going to absolutely agree on everything, pretty much. This is a bill, obviously, was written by the previous government under, I think we'd all agree, 14 years of strong and stable government, and it was one of our but look, we, in the broader sense, we aren't going to disagree on this. As the Minister set out in her opening speech, this legislation was born out of the learnings of the failure of Silicon Valley Bank. And it was a failure that came out of the US parent company with a contagion that quickly spread to its UK subsidiary. While initially the Bank of England had planned to use insolvency procedures, thanks to tireless work over a course of a weekend in March 2023, HSBC emerged as a buyer. And much credit must be given to the former Chancellor of the Exchequer, the member for Godalming and Ash, and the former Economic Secretary to the Treasury, the member for Arundel and South Downs. They secured an outcome that has not cost the taxpayer any money at all and protected millions of pounds worth of customer deposits, primarily in the tech sector. These customers of the bank face an uncertain financial future were it not for this intervention. And therefore, I'm sure that the House will join me in commending the action that was taken by the previous government on this particular point. The failure and subsequent transfer of Silicon Valley Bank UK showed how robust our post-2009 banking reforms have become. The Bank of England has only used its resolution powers 3 times since 2009, and this was the first time since South Sea Mortgage and Investment Company failed in 2011. And it's fair to say the process worked absolutely as it should have done. The transfer of Silicon Valley Bank to the UK to HSBC was done very much in an orderly manner. And there was no wider contagion in the banking sector. Withdrawals and panic did not spread to other banks, and in short, it demonstrated why the UK is such a financial centre of excellence, and we must continue to champion that point. But we can only continue to uphold our world-leading reputation if we review and learn from when the system is stressed in real life. In some ways, we were very fortunate. HSBC was the only credible bidder for Silicon Valley Bank, which did not require financial support or guarantees from the government or Bank of England. And in addition, their level of capital and liquidity resources greatly reduced the risk to public funds, delivered stability and boosted market confidence. However, if HSBC had not come forward, there was no other option but for the Bank of England other than the bank insolvency procedure. And rightly, out of the root and branch review that was subsequently undertaken, has come this bill, the Bank Resolution Recapitalisation Bill, and a bill that went for industry consultation under the previous government, and one that I think the current government, one that I thank the current government for supporting. And on this side of the House, we recognise that in the financial sector, some banks may fail for issues outside their control and should have pathways to continue as a going concern if transferred to another entity. And it's right that the Bank of England has more tools in its arsenal to support the financial system. And therefore, on this side of the House, we are absolutely, it says here, happy to support the bill. We're delighted to support the bill. It's one we started. However, as the bill made progress in the other House, it benefited from considerable scrutiny from noble peers. The successful amendments which enhanced this bill and have brought new clauses to it, when the regime will continually, significantly improve transparency. And this is a point addressed by my right honourable friend, the member for North West Hampshire, during the Delegated Legislation Committee on Monday, which finalised the transfer of the Silicon Valley Bank to UK to HSBC with no compensation to shareholders. He rightly raised some of the unanswered questions on what changed in the Bank of England's decision between announcing that Silicon Valley Bank UK was going into bank insolvency procedures on the Friday to being transferred under resolution by the Monday. These additional transparency arrangements will ensure colleagues in this House remain confident in the independence of the Bank of England. So can the Minister, when he winds up, confirm whether the government intends to support those amendments in this House? And I'd be amazed if he said no, actually. Now, I'll move on to what could be the crutch of any potential disagreement that we may have. And when this bill was introduced in the other place, there was no limit to the scope of this regime. We can safely categorise our banks into 3 different groups. Firstly, there are the large-scale institutional banks that have reached end-state minimum requirements for own funds and eligible liabilities, MREL, as you know. Secondly, challenger banks such as Monzo and Starling that are working towards end-state MREL. And then finally, smaller banks that do not meet the threshold for MREL, such as Silicon Valley Bank in the UK. Banking Act 2009 provides a robust framework for dealing with banks that have achieved end-state MREL status. And while there is a sensible argument for saying the new mechanism could provide top-up funding for banks working towards end-state MREL, it is not fair or reasonable to expect the mechanism to be used for the largest banks. The consequences of such a decision would be extremely costly for banks potentially and their customers. And if an institutional bank failed and this mechanism was used to facilitate a transfer, our fear could be a recapitalisation requirement that is many times the annual cap of the Financial Services Compensation Scheme. And therefore, the only decision left to the FSCS would be to borrow from the National Loans Fund via the Treasury. The ex-post levies set out in this legislation would not only therefore be charged in the year in which the levy is first implemented, but potentially for many years thereafter. So MREL requirements should ensure the safety of our largest institutions. Bank directors should be ensuring sound compliance of MREL, not taking comfort in the fact that they can fall back onto an ex-post levy of the banking sector in times of trouble. And on this side of the House, we took reassurance from a policy statement that the mechanism would only be used for the largest banks in exceptional circumstances. However, it still left the key question as to why the legislation allowed large-scale banks to trigger the mechanism. And in her opening speech, the Minister referred exactly to this. Baroness Weir's amendment makes clear that this mechanism cannot be used on the largest banks, those that have achieved end-state MREL. And this amendment was opposed by the party, but by the government, in the other place. So, and I was going to hope that the Minister will update the House today on the government's position. She has already done that, but I think it's something which we may want to talk about at greater length. Concerns were also rightly raised by peers that this mechanism and using resolution to transfer failing banks should not become the default position of the Bank of England, which is very important. Banks ultimately are businesses. They have shareholders that bear the responsibility and the burden of risk. And we shouldn't create a system where banks can expect to always fall back on industry-funded life support. The Code of Practice, alongside this bill, rightly states that using the insolvency procedure should be the default position. And I would welcome the Minister's comments on whether there could be further need for this to be strengthened in the legislation. And finally, the introduction of this mechanism is another example of banking industry in strong health. In 2007, it was a taxpayer bailing out the banks, and now we have a system whereby the industry is expected to cover the cost of a failing bank. So it raises questions as to whether the government needs to review how we can make the UK banking sector more internationally competitive. And so I think we've had a chat informally about this, but take, for example, the bank levy. The bank levy was introduced, really, when you look back on it, for three main reasons. It was firstly introduced to help repay the cost of the banking bailout. And the bank levy has now raised something in the region of £25 billion since it was first introduced. Secondly, it sort of acted as a kind of insurance premium in case the post-financial crisis stability in the banking sector were to falter and fall and there was needed to be another bailout. But finally, it was almost as a quasi-punishment to the banking system for the failures that led to the financial crisis. And it was there to reassure unhappy shareholders that there were consequences of a sector where there was bad practice within that sector. But the total cost to the UK taxpayer for the financial crisis, if you add it up now, as of, I believe, 2023, according to the House of Commons Library, is £137 billion. That has been reduced to £33 billion now, so there still is some outstanding cost. But on top of the bank levy, other post-2000 reforms include much more stringent ring-fencing on capital requirements. Now, whilst it might not be a debate for this bill, and I'm not calling for the bank levy to be abolished, I would certainly welcome at some point the Minister's comments on whether there could be scope to review international competitiveness on the banking sector alongside the Chancellor's growth agenda. The international competitiveness of the City of London should be an absolute priority for this government, and I believe it is, actually. Yet according to UK Finance's 2024 Banking Sector Tax Report, produced by PwC, UK banks face the highest tax contribution since the study started a decade ago. In terms of international competitiveness, according to PwC, the total tax burden of a model bank operating in the UK is currently 45.8%. That is significantly higher than our competitors in Frankfurt at 38.6%, in New York at 27.9%, or Dublin at 28.8%. The city, as I'm sure ministers will agree and the whole House would agree, is an extraordinary asset for this country. And for a government that is seeking the growth agenda, the city is the oil in the engine of that economic growth. Banks do a very important job. And indeed, it's a job of significant social and economic importance. Banks take money from where it has accumulated and distribute it to where it is needed for investment. It is crucial to fairness across our economy and delivering growth. They also transfer an overnight deposit into a 25-year mortgage that provides hope and opportunity for families to bring up their families in safety. So we should not demonise banks. And indeed, we must remember that shareholder returns on bank investments are as important as is shareholder liability in the event of a failure. We must make sure that there is good return, given the fact that there is ultimately the ultimate risk, which is losing everything as a bank shareholder. So I think this bill is a shining example that the banks and regulators are now in a position to keep their industry in order. And as I said at the start of this speech, I believe there is I believe there is cross-party support for this bill, and I absolutely look forward to working with the party opposite as these reforms progress through the House. They are magnificent, but they of course came from the previous government, but I should thank the ministers for continuing with them in the spirit that they were intended. Thank you, Madam Speaker.
Adam Jogi.
Thank you very much, Madam Deputy Speaker. And I'd like to start by welcoming my two honourable friends on the front bench to their new positions. The new Pensions Minister and I go way back, and I'm enjoying being able to now address him as Minister in His Majesty's government. So congratulations to both. I have to say I didn't quite agree with the Shadow Minister's description of strong and stable for the previous government, but it was certainly worth a try. Now, Madam Deputy Speaker, and I mean that's in all good spirit, honestly, I thank the Minister for her speech and for her very thorough but accessible explanation of the reach of this bill. I shall look forward to telling the people of Newcastle Lyme tomorrow on the doorsteps of Town Ward. Madam Deputy Speaker, there's a by-election tomorrow, which I look forward to the Labour candidate Sheila Case-Hume winning, and I will make sure that I share the benefits of this bill with the voters in my constituency when I knock on their doors tomorrow, Madam Deputy Speaker. Now, this bill has the good fortune of being supported by both sides of the House. We've heard that from the Shadow Minister, and so to reassure all colleagues, I shall speak very briefly indeed. Now, whilst I, Madam Deputy Speaker, have never been invited nor received an invitation for a prawn cocktail in the city, this bill nonetheless is all good things come to those who wait, Minister. This bill and the issues contained in it are important, and I'm pleased to be here to speak in favour of the bill today. And I've just got a couple of points that I'd like the Minister in his wind-up to touch on. Firstly, I wonder if he'll be able to set out in greater detail, Madam Deputy Speaker, how the pay slips of workers in Newcastle and Lyme will be protected by the contents of this bill. Now, the finances and livelihoods of my constituents are obviously a focus for me, so making sure that anything and everything that this government does to protect and enhance their lives, I will welcome, as I will to growth across the economy. So anything the Minister can do to provide some reassurance, both on the growth agenda generally, but the specific benefits of this bill, I would welcome. Now, Madam Deputy Speaker, as all keen newbies, I read the Hansard debate in the other place ahead of this debate, and I hope that the ministers on the front bench will ensure that the very legitimate points that were raised by their noble lords across the House were taken on board and listened to. Now, one noble lord noted, and I agree with him, that small banks play a big role in our economy, and so I want to thank the Minister, and I think the Shadow Minister noted this too, for acknowledging that. I also want to echo the points the Shadow Minister made about the importance of the city. It is obviously an engine both of growth, both of reflecting the success of our country and the strength of our economy. But my focus as a Member of Parliament for Newcastle Lyme is making sure that growth, that benefit, that skill, that powerful engine reaches up the M6 to junction 15 so that my constituents in God's own county of Staffordshire can benefit from all that the city does. Now, this is a technical bill, Madam Deputy Speaker, but it's an important one, and I'm very pleased to be here today to give it my support.
I call the Liberal Democrat spokesperson, Daisy Cooper.
Thank you, Madam Deputy Speaker. All of our constituents are still feeling the cost of living crisis very acutely, and mortgage holders are still suffering from the misery of the mini-budget. So the very last thing that taxpayers want to be worrying about is whether public money will be used to bail out banks that have gone bust. And that is why we Liberal Democrats are broadly supportive of the bill, which we hope will make sure that taxpayers won't have to do this. In the other place, a number of improvements were made to the bill, as the Minister has alluded to, and we welcomed those improved requirements on reporting and accountability. But there was, again, as the Minister and Shadow Minister have acknowledged, a point of contention around the scope of the bill. In the other place, we Liberal Democrats did support the successful opposition amendment, which would prevent the Bank of England from using this mechanism, which is to support smaller banks, prevent the Bank of England from using it for bigger banks that are signed up to a different scheme. Now, the Minister has said that an updated code of practice has been produced, but it is disappointing to hear that ministers intend to table an amendment at the next stage to try and delete this amendment and withdraw it from the bill. The Minister suggested that the purpose for keeping it in the code of practice rather than on the face of the bill was to ensure that there was some flexibility in a time of crisis. And I wonder whether I could invite the Minister to say a word or two about that in summing up, because it strikes me that if this is not on the face of the bill, in a time of crisis, rather than providing flexibility, the flip side of the coin is that it creates uncertainty. And there is a danger that even the prospect or the suggestion that this mechanism could be used for a bigger bank could cause some chaos and confusion and certainly instability. So I wonder if the Minister may say a word or two about that, and if I may encourage ministers to think again on this issue and make sure that the restriction on the scope of the bill remains on the face of the bill. There was also a further amendment that the Liberal Democrats tabled in the other place, which was seeking to place a secondary objective on the Bank of England to consider the competitiveness and growth of the market before directing the recapitalisation of failing small banks through this levy. In effect, the thinking behind this amendment was that it was designed to protect against unintended consequences. Obviously, it could be a catastrophe if the Bank of England was required to rescue one small bank, even if that act may put others in jeopardy. So the intention behind that amendment was very much to try and protect against the systemic collapse of the banking system. So I wonder if the Minister, in summing up, could maybe set out what the government's objections are to that particular amendment, and also explain whether there are any other assurances that the government can provide about alternative protections that could be put in place to achieve that very same goal of making sure that we protect against unintended consequences.
It's Malthouse.
Deputy Speaker, I'm grateful. I draw attention to my entry in the register. I have no desire to detain the House for long, but I did have some questions for the Minister, which I hope she can address, which is a continuation of our conversation that we had in committee earlier this week. Now, she and I are both alumni of the City UK, and so she will know, as I do, that what financial services wants most of all is certainty of regulation and decision-making. They need to know that the playing field is level and predictable. And while we're all patting ourselves on the back about Silicon Valley Bank, that consensus about what a good job everybody did made me slightly suspicious. There were effectively 3 decisions made by the Bank of England in the unravelling of Silicon Valley Bank, which I wanted to, I guess, put on her desk for her to consider about whether more is required from the Bank of England about certainty of trigger of those decisions and what implication they may have. So, for example, the first decision the Bank of England took in Silicon Valley Bank was to deny them short-term funding. SVB UK, the branch, was a solvent bank, as it would have to be as a subsidiary within the UK, regulated by the Bank of England. They applied for, I think, 1.8 billion of short-term funding when it became clear that their parent was in trouble. That funding was denied to them by the Bank of England, and I don't think there's ever been any significant examination of why the bank took that decision. Obviously, there was a run on the bank taking place, depositors seeking to pull their money out, which the bank was unable to honour those withdrawals. That's why they applied for the short-term funding. There was an alternative route, which could have been I guess, a temporary freeze on withdrawals and indeed the provision of short-term funding that could have meant the bank continued as a solvent entity within the UK and indeed might have got a different route. And so understanding fundamentally what the trigger for that decision was and what decision-making other banks in similar circumstances could rely on in the future of the Bank of England, I think, is key. The second decision that was taken, of course, was then, as my honourable friend has said from the front bench, that the Bank of England initially decided to put them into insolvency and rely on the 85,000 quid for depositors, 170,000 for joint depositors, and they changed their minds. We don't really know why. By all means.
I can tell I'm going to enjoy discussing these matters with the honourable gentleman. I have looked into this since our exchange on Monday, and I just wanted to clarify what happened on the Friday before the Monday. He knows which Friday and which Monday I'm talking about, in March in 2023. The Bank of England issued a statement in the evening of the Friday saying they intended to apply to the court to place SVB UK Limited into a bank insolvency procedure absent any meaningful further information. However, over that weekend, a buyer came forward, and that was the change between Friday and Monday, and it was judged to be in the public interest and indeed in the interest of the customers of SVP UK, that indeed the resolution as it proceeded for the Monday morning was preferable to the insolvency procedure which was announced on the Friday. Sorry, Mr. Chairman.
That is obviously useful information about the bank's decision-making. However, they still decided to go for insolvency prior to a resolution mechanism, and I find it hard to see that within that 24-hour period, or indeed 36-hour period, they hadn't taken the decision to canvass whether there was some kind of a market for the bank. I think my point remains, which is that if I am an investor or an overseas bank trying to establish a branch in the UK and investing significant funds in it, I would like to have a bit more certainty, or at least understand why the Bank of England is making the decisions it is making, and within what criteria and parameters it is likely to make a decision either way. And then, of course, the final decision was taken to sell the bank to HSBC, or transfer it, I think, for minimal consideration. And what I really want to understand in that circumstance is what balance of value was weighed upon the bank going to HSBC versus any of the other banks who might have been bidding for it. And at the heart of this, I have a worry about competition. Where a bank is put into this resolution position, obviously it needs to move to another bank which has significant assets and is able to support and fulfil the rightful demands of its depositors to withdraw their funds or not, as they may wish. That will naturally be a bigger bank. And there's a possibility here, hopefully not, we won't be using this very often, there's a possibility here that small, challenger, higher risk banks may find themselves caught between their inability to obtain short-term funding from the Bank of England because of their size, and therefore find themselves effectively gobbled up by the leviathans of the banking system. And so that over time there will be a natural move back towards where we used to be prior to all these challenger banks appearing, which is having 4 or 5 massive banks which dominate the system in an uncompetitive way. And so I guess what I'm asking the Minister to consider in not necessarily changing the legislation, but in the conduct of this bill and the Code of Conduct, what consideration the Bank of England has to give to the competitive landscape when it is resolving a bank, and whether when it transfers a bank, for example, one small bank to another small bank as part of a resolution, that wheel might be oiled with a bit of short-term funding to the other bank, not falling on the taxpayer, but short-term funding, effectively a loan for repayment, to maintain that competitive landscape. Because I think one of the benefits, if you like, the silver linings coming out of the cloud that was the crash of 2007-8, was that we have a much more diverse banking landscape than we had before. There was a recognition that having these huge organisations, that if they fail, crash the entire global economy, was dangerous for the Western economy, and therefore having a much more diverse landscape, as I said, was desirable. The problem with that is obviously there's more inherent risk in those smaller banks. If there's more inherent risk, we're likely to see more resolution, and we may, over time, end up back where we were. So I support the bill. I do think resolution is exactly the right way to go, and we should obviate the risk to the taxpayer. But there are also negatives to the system. And so I hope that in doing the job with aplomb, which I'm sure she will do, she will think carefully about the impact of the decision-making of the Bank of England and its predictability for the world, and what the bank can do to provide transparency in that, whether it's code of conduct or indicators of practice or whatever they might do, and also then what the impact of resolution may have on competition more widely. Thank you.
Shadow Minister Mark Garnier.
Well, thank you very much, Madam Deputy Speaker. And with the leave of the House, it gives me great pleasure to wind up on behalf of the opposition. So first of all, can I thank the handful of members that have made a very helpful contribution. The new member for Newcastle-under-Lyme rightly asked questions on behalf of his constituents as, are they going to be under the cosh if a bank goes bust again, which they shouldn't be under this, and what a bank's going to do for him in order to generate economic growth in his area. The Liberal Democrat spokesman, member for Albans, rightly raises the point about the extension of this being used for the larger banks, which is something which is not the intention of it. And as ever, my right honourable friend, the member for North West Hampshire, brings his intelligent scepticism on what can happen with this and actually demonstrates why Parliament is such a brilliant place when it comes to intelligent people such as him scrutinising what goes on. Can I also welcome the Minister? With his glittering career, which has done so extraordinarily well, with his meteoric rise to not one but two government departments as a Minister in his first Parliament, his double hatting already, but he's a clever chap. We've come across each other in the past. Look, I won't take too much time in the House, Madam Deputy Speaker. I've been on my feet just a few minutes ago, but it does come back to really, I think, 3 points which I hope the Minister will address. Firstly, it comes back to this amendment. I think the Minister made her point in the early one, which is that I think the government does not want to support the amendment that was put through earlier. This may come up and we may have more conversations about that. Secondly, does the Minister feel that the Bank of England's Code of Practice provides enough reassurance that the bank insolvency procedure remains the default option for failing smaller banks? And then finally, how does the Minister weigh up continued use of the bank levy and regulation on our banking system against the Chancellor's growth agenda? Although I do appreciate that is beyond the scope of this bill. As I said during my opening remarks, Madam Deputy Speaker, this bill remains one with actually surprisingly strong cross-party support. It's a good thing that the Bank of England has more tools at its disposal during periods of heightened stress, and the version of the bill before us today, as amended in the other place, is a more robust piece of legislation than it started. So we absolutely look forward to getting clarity from the newly appointed Shadow Minister. I very much look forward to hearing... Sorry, yes, absolutely right. My apologies, Madam Deputy Speaker, the newly appointed Minister. Congratulations on his appointment. Thank you. Yeah, it'll be a few years before that. Thank you very much.
Minister Torsten Bell.
Thank you, Madam Deputy Speaker. I'd like to thank all honourable members for their contributions to this debate, which were small in number but high in quality. And I should also thank those who contributed elsewhere in the other place, but also those who responded to the consultation that brought this bill forward. As today's short debate has demonstrated, there is broad support, both political and industrial, for this bill. I also want to thank the opposition bench for their kind words, but also their constructive approach they have taken, and particularly to echo the honourable member in thanking previous Treasury ministers, not least the Right Honourable Member for Godalming and Ash, who have brought us to where we are today. Now, these are relatively modest, targeted and proportionate enhancements to the UK's resolution regime. That regime was established in the wake of the global financial crisis, and its powers were put to the test when Silicon Valley Bank UK failed in March 2023. That episode demonstrated that the regime was broadly working as intended, but it is right to learn the lessons from that experience. Those lessons are, as we've discussed, that firstly, the implications of a firm's failure cannot always be anticipated before the event, and sometimes it can be in the public interest to use resolution powers even on small firms that were not deemed systemic prior to their failure. That was the case with Silicon Valley Bank UK. And had it been insolvency would have had implications for public confidence in the stability of the UK financial system. The second lesson is that there exists a potential gap in the resolution framework for managing the failure of such firms. These firms do not hold the additional resources to absorb losses and facilitate recapitalisation in the event of their failure. While Silicon Valley Bank was well capitalised, it was therefore possible to find a willing buyer in HSBC, but such an outcome may not be possible for a small bank with a shortfall in capital, and at present such a shortfall would have to be met through the use of public funds, and there is cross-party support that is a risk we wish to reduce. And we also wish to increase the options available to the Bank of England for managing the failure of a small bank. The bill does so without imposing any new upfront costs on the banking sector, nor fundamentally altering the broader resolution framework, which has been shown to work well. It rightly does not alter the public interest test that underpins the Bank of England's decisions on whether to use its resolution powers or to place a firm into insolvency, a point I'll return to shortly. And I'll currently come to the points raised by honourable members. The Shadow Economic Secretary raised a number of points, but I broadly agree with his description of events of Silicon Valley Bank UK. It was a helpful summary of development, and I can confirm that the government does welcome the amendments added in the other place, with the one exception raised by my honourable friend, and I know we'll be discussing that further in the committee stage to come. We have been clear that these powers are to be used for smaller banks, and also clear that this bill, these powers, does not mean that their use will become the default. As you say, insolvency for small banks remains the default approach to be taken. The honourable member also raised the wider question of banking taxation, and I'm sure we'll be discussing that in the months and probably even years to come. Our view is that banking taxation remains competitive, but his comments have been noted, and that's something that we will always keep under review. The honourable member for St Albans focused on the proposed size limits for banks. As I have mentioned, we don't think that is the correct way forward, but it will be something that we'll continue to discuss, because while the intention of this bill is that these powers will be used in the case of small banks, the lesson of the last 20 years, not just in the UK but around the world, is that flexibility is important when it comes to how we resolve bank failures. She also mentioned whether a wider growth objective should be inserted for the Bank of England. This is a narrow bill, and we don't think it's the right place to discuss wider issues about the bank's approach, and the public interest test, which the bank is already required to apply when it comes to resolution questions and questions of bank failure, provides much of the protections that she is seeking to cover. The honourable member for Newcastle Underline asked about the impact on ordinary workers, which is a good question and something we always do need to come back to. And again, another lesson of the last 2 decades is that a stable and strong banking sector is an important underpinning for a strong economy and for rising wages right across the country. Now, Madam Deputy Speaker, I started in my career in the Treasury in the years when the UK and other advanced economies were having to swiftly relearn that banks can, and they do, fail, and that the consequences of them doing so in an unmanaged way are very big and very bad indeed. The lesson from that crisis was clear. A comprehensive resolution regime is important for protecting financial and economic stability and public finances in bad times, but also for underpinning confidence in the financial system at all times. This lesson is especially significant for the UK, where the financial services sector plays such a vital role in our economy, as the honourable member powerfully made the case. We have also learnt that it is important for the Bank of England to have a range of tools available for managing firm failures, because those failures can be unpredictable. The best tool for managing the situation is not always apparent prior to the point of failure, as evidenced by the failure of Silicon Valley Bank UK. That is why, despite the UK's resolution regime having worked well in practice, the government believes it is important to learn the lessons of the banking sector volatility of 2023. The targeted enhancements in this bill provide the Bank of England with a more flexible toolkit to respond to the failure of smaller banks, while also protecting public funds. This bill also supports the government's growth agenda. While it is common to focus on the trade-offs between regulation and growth, confidence in and the stability of the banking sector are key to supporting long-term growth. Madam Deputy Speaker, I'm glad to have heard the broad support for this bill in the House this afternoon. Assuming that support continues into at least the next few minutes, the government looks forward to engaging further with honourable members at the committee stage, and I commend this bill to the House.
The question is that the bill be now read a second time. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Programme motion to be moved formally. The question is, as on the order paper, as many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Money resolution to be moved formally.
to be formally.
Where's the debate?
The question is, as on the order paper, as many as of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Ways and Means resolution to be moved formally. The question is, as on the order paper, as many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it.